Thanks for joining us. In our recent article, we analyzed the Finance Act and other developments alongside its impact on operations of foreign companies in Nigeria. As the country awaits the President's assent on the latest Finance Act 2022, this article seeks to evaluate some of the amendments to the tax laws introduced by the Finance Act that impact NRC's operations in Nigeria. Prior to January 2020, when the first Finance Act was signed into law, the Nigerian tax laws had not been reviewed for several years, and tax positions adopted by non-resident companies on their Nigerian tax matters tended to subsist for a long time. This has since changed as the federal government has used Annual Finance Act as a fiscal tool to amend relevant laws that impact how businesses are carried on in Nigeria. On 24th July 2014, the Federal Inland Revenue Service (FIRS) mandated NRCs to file full tax returns like their Nigerian counterparts. This was a departure from the norm, as NRCs were previously subject to tax on deemed tax basis. In effect, the NRCs were required to include actual profits made from Nigeria operations, capital allowance computations, and audited financial statements effective from 1st January 2015 based on a public notice issued by the FIRS. The intention of the FIRS was to have more visibility on the actual financial results of NRC's operation in Nigeria with the hope of collecting more tax revenues. This approach did not yield much results, as many NRCs reported losses. Some NRCs were also not liable to tax based on the extant laws at the time. Consequently, the basis of taxing NRCs as provided in Section 13 of the Companies Income Tax Act was reviewed and amended by the Finance Act. The amendments introduced in paragraph 3 to 5 of Section 13 of CITA brought more NRCs into the tax net, even where they did not have a fixed base or permanent establishment in Nigeria. Many NRCs earn more than 25 million naira requirement to qualify for SCP from remote operations in Nigeria, which may not have been the case prior to the amendment. Thus, NRCs operating in Nigeria should review their operations and ascertain that they do not have new tax obligations in Nigeria based on them. Furthermore, Nigeria has double tax treaties with 16 countries, which is aimed at ensuring a company resident in the DTT states suffers tax only once for income derived from any of the contracting jurisdictions. Typically, the DTTs provide that an NRC will only be liable to CIT in Nigeria where it has a permanent establishment in Nigeria. In conclusion, as the nation prepares for election in few days, the next government will have to evaluate the existing tax regime in order to simplify it further, expand the tax base, and explore new initiatives that will attract the much needed investment to stimulate the economy. NRCs should continue to monitor developments in the tax space so they can take full advantage of the investment opportunities that exist in Africa's biggest economy. To read more on our articles, please visit our website and subscribe using the button below. Thank you.